Hello and welcome to The Enterprising Investor, the flagship investment podcast for CFA Institute. I'm Mike Wahlberg, and I'm pleased to hand the reins again this episode to CFA Institute's Managing Director of Education, Chris Wiese, who interviewed Mark Anson at this Institute conference in Chicago last May. Mark will be a well-known name to many listeners as he's led many of our industry's largest asset management firms and pension plans over the years, including the Bass Family Office, $900 billion juggernaut Nuveen Investments, Hermes Pensions Management, and both Britain's largest pension plan for British Telecom and the U.S.'s largest institutional investor, CalPERS. An award-winning author, he's published over 100 journal articles and literally wrote the textbook for the Kaya program. With a PhD from Columbia, a CFA charter, along with Kaya, CPA, and Chartered Global Management Accounting designations, he threw in a law degree, because why not? Today, Mark is the CEO and CIO of the Commonfund and chairman of Commonfund's capital and asset management companies. In their chat, the two cover key lessons Mark's learned managing money across the globe. They touch on his 30-30-40 asset allocation process, trends in asset correlations, his focus within EM markets, the recipe for success when investing in private markets, the impacts of current White House policies on taxation of endowments and managing risk, and he finishes up with a discussion of future trends in our industry. It's a packed 20 minutes. Here they are.
Well, thank you for joining us.
Pleasure.
Mark, you've led major institutions like CalPERS, British Telecom Pension Scheme, Nuveen. What are some of the key lessons that you have learned from managing investments across different regions and regulatory landscapes?
Well, let's start with regulation. Regulation is a constraint. The basic idea of regulation is to have some oversight on what you do. Now, of course, here in the United States, we have the Securities and Exchange Commission, and they have very clear and strict laws with regard to being an investment advisor and how you construct your business around that. So that's one of the things you have to think about when you operate on a global basis is what are the regulations in the country in which you're operating. At Commonfund, we have offices in China, London, Munich, as well as Connecticut, New York, and San Francisco. So we have to understand what the regulatory landscape is in each one of those countries in which we have an office. And then what that means in terms of not only the investment products we might sell, but also how we interact with investment managers in those different landscapes. So again, regulation is a necessary oversight for every country, but it provides constraints on how you operate your business.
Let's talking about how you operate your business. You're a proponent for the 30-30-40 asset allocation scheme, right? 30% equities, 30% fixed, 40% alternatives. Do you like to talk about that a bit and how you come to that within the space you operate?
Well, first, with regard to 30% public equities, what we've seen over the last couple decades now is the landscape for public equities in terms of diversification has shrunk. It used to be you got a lot of diversification just through investing across boundaries, geographic borders, U.S. versus international versus emerging markets. But what we've seen over the last 20 years, particularly with China joining the World Trade Organization, is the investment across borders doesn't bring you the same level of diversification as it once did. It's just a fact of the correlation of the markets. It used to be the G7, the 7 largest economies. Then it was the G10, then the G15. Now it's the G20. So what you see on a global scale is indeed we invest in global markets, and those markets are becoming increasingly synchronized and coordinated both on monetary and fiscal policy. Now, what's interesting, just as I say that, we've actually seen a little divergence right now. There's arguments to be made here in the United States that the Federal Reserve Bank should be raising rates or cutting rates, and it's not clear what they're going to do. At the same time, we see Japan becoming more aggressive in raising rates, the ECB lowering rates. So suddenly, even despite what I just said, there seems to be a bit more diversification or certainly diversion of monetary policies around the world. All that being said, if you look at, for instance, the S&P 500, the correlation of that with, let's say, MSCI EFA, today, that's about 95%. Very different from 20 years ago when it was only about maybe 50 or 60%. So the global markets have become more coordinated and they tend to react similarly. That means diversification isn't as robust in public equity markets as it once was.
Right.
which is why you then have to expand your portfolio into alternatives a bit more than you used to. And when I think of 30, 30, 40, that 30% is not just traditional bonds. It's credit and private credit. It's mortgage-backed securities. It's looking at everything that might have a yield component to it, as opposed to a growth component in public equities or private equity. That was a long-winded answer, but let me stop. There's a lot to unpack there.
So when you, let's take the public equities component and the high degree of correlation you talked about. So how much energy do you put into balancing your exposure in different markets given that?
So at Commonfund right now, as an example, we tend to have a bias towards the U.S. In fact, when we look at our public equities portfolio, there's a slight leaning towards the U.S., but we've also begun looking more carefully at emerging markets. We still see good growth opportunities there and a bit more diversification than what you get in developed markets ex the U.S. Now, of course, when we think of emerging markets, you've got China, the second largest economy in the world, still an emerging market, right? Even though it's our second largest economy. So that sucks up a lot of volume or investment capital. But certainly there's other places to find value in emerging markets. And so we look for managers that are just doing emerging markets as opposed to global mandates. And one of the things that we have found, of course, is when you think of the growth trajectory of emerging markets with young labor forces, trying to build up middle class, just like we have here in the U.S. at a consumption-driven economy, you see all that coming through the emerging markets, which is why we think that gives us an opportunity set, maybe a bit more robust than looking at just developed market economies.
And through what mechanism do you, the alternative allocation, through what mechanisms do you get into that?
So we are, at Commonfund, we invest significantly in private capital. And for us, that's private equity, so leverage buyouts. It's venture capital. It's natural resources. It's sustainable resources. It's secondaries. And then it's private real estate. And we've been longtime investors in private capital going back 40 plus years in our client portfolio. So early adopters into private equity, venture capital, and the other illiquid asset classes. One of the things that we did several years ago at Commonfund was produce a paper that actually identified the liquidity premium, that extra premium you should get for investing in illiquid assets. Long-term average is about 3.6%. So that's one of the things we identified, the size of that premium over the last 20 plus years. We then shocked that premium to see if it was indeed a standalone risk premium compared to the equity risk premium or duration or credit. And indeed it is. The catch is to get that liquidity premium, you can't capture that premium passively. There's no ETF or index fund. So the way you have to do it is by finding good investment managers in the private capital space that will capture that liquidity premium for you.
And I imagine a lot of them. Like I imagine you have to be very well diversified there.
You do, but you know what? In some places it doesn't work very well. Venture capital would be a great example. Venture capital, to perform well in venture capital, you really are investing with just a handful of the best known venture capital firms. Venture capital really is a game of access as well as an asset class itself. So it's an access class and asset class at the same time. And that means that there's probably about 10 great venture capital firms, Sequoia, Kleiner Perkins, Lightspeed, et cetera, that tend to have a virtuous circle of getting the best entrepreneurs coming to them and finding the best opportunity set. So in venture capital, broad-based diversification really doesn't work. If you diversify away from those top names, you're really diversifying down towards the median. Now, back though with private equity, so that's leverage buyouts, traditional growth capital. There are literally now thousands of private equity firms out there. So there's plenty to choose from and plenty to diversify in. What we have found investing in the buyout space, what we call private equity, is you want to invest with those firms that bring operational experience to the table. And typically they're just focusing on one or two industries. Could be franchise, it could be the automotive industry, it could be banks and finance. But we look for private equity managers that focus and have a target of just one or two industries. We find that's where we capture the best returns.
Let's go back at a portfolio level. I know you're concerned about taxes, and what I think you're following the potential for taxation on endowments and changes there. So, How does that affect your view on how you'll run things?
What we, at Commonfund, our goal is not to be political, but to assess what political ramifications might be as they impact our client portfolios. And our clients are endowments and foundations. And as we have heard from the current White House administration, they are proposing some level of increased tax on endowments. And what that means is you're now adding a new constraint to the portfolio construction process. One of the wonderful things of an endowment or a foundation has been their tax-exempt status, that you can construct a portfolio without having to allocate or plan for taxes. Now we might have to do that. Before Commonfund, I worked for the Bass Family Office, which is the billionaire family based out of Fort Worth, Texas. Every year, we would go through what's called tax loss harvesting. We looked to see where there were losses in our portfolio that we could capture, harvest, and use to offset the gains in other parts of the portfolio so that you could lower your overall tax bill. For endowments and foundations, you haven't had to consider that. But that would be potentially a new part of the portfolio construction process if indeed there is going to be a tax on endowments. You would have to build this tax loss harvesting into the portfolio construction process. The other thing that taxes on endowments would do is it makes you burn the candle at both ends. On the one hand, to shrink your tax bill, you want to invest long-term for long-term capital gains. But the flip side is you have to pay taxes. So you need some short-term investments as well. And that's the candle burning at both ends that you're going to have to learn how to balance. So we'll see what the potential tax rate might be, but it definitely will have a significant impact on how we construct portfolios if our clients start to become taxable as opposed to tax exempt.
Well, how about a similar topic I know is on everyone's mind at the moment is risk management. So given your experience at some of the world's largest pension funds, and what are the principles that guide your approach to risk management, especially in an environment like we're dealing with year to date?
Well, certainly one of the risks we've had here is a new administration in the White House bringing a new policy shift regime, tariffs. And we're all trying to sort out what the impact of tariffs will be. Again, when you read the economists out there, some say the Fed should be raising rates to fight potential inflation from tariffs. Others say the Fed should be reducing rates because tariffs may slow down the economy and potentially push us into a recession. So that's one key risk. And the risk there is not just the tariffs themselves, is what will be their economic impact. What we've seen is what are called the uncertainty indexes. So the Federal Reserve Bank of St. Louis produces an uncertainty index. And what they measure are such things as just what's the number of newspaper articles and journal articles about the uncertainty, the economic uncertainty. They measure the dispersion of economic forecasts. Anyways, when you look at this uncertainty index, it's spiked almost all-time highs, close to where we were in the middle of COVID. And what that demonstrates, again, is when you have uncertainty, dispersion in the market, that increases the volatility. And so that's one of the things that we're worried about right now as we look at risk management. One, not only will be the impact of tariffs on the economy in the U.S., will it result in higher inflation? Will it result in slower growth? Could it be stagflation? How will that impact our client portfolios? And then how do we think about our portfolio construction process around that? So risk management for us is not only looking at the traditional risk premiums such as duration and credit and liquidity premium, the equity risk premium, and where they are today and how they're impacting our portfolios. It's looking at these administrative shocks that will come in, exogenous to the economics of the market, and how they then impact the economics of the market. And that's what we're focused on right now. Again, a very long-winded answer, but hopefully that got to the question you asked.
Well, let's maybe take it up to a little bit higher level. So this next question, I'll let you choose your own adventure to a bit. Future trends in investment management, and I'll let you decide whether you want to address that from a geopolitical perspective or a technological perspective or otherwise.
We'll start with politics and economics. I mentioned the World Trade Organization earlier on in my comments, formed many years ago to try and bring countries together, share information, coordinate fiscal and monetary policies, share supply chains. That seems to be breaking apart. I think we all see this more local onshoring, whether it's the U.S. or Mexico or Canada. And the tariffs, of course, are reinforcing that. So I think that's one trend we have to deal with. It's no longer globalization. It might be regionalization or maybe even isolation. And so that trend, at least for the next 4 years, I would expect to continue while we have the current administration working through their tariff policy. So that's one trend. I'd say another trend that we see is that there is a lot of capital flowing into illiquid assets. Commentary around private equity being the new crowded trade. So much capital is flowing into that, and there's so many private equity managers now. We're less concerned about private equity as a crowded trade. Again, it comes back to what I mentioned earlier. When we look for good private equity managers, we look for those private equity managers that have one or two industry domain expertise. Again, I mentioned we invest with one great manager out of Atlanta, and all they do is they look at franchises, things like Arby's or Subway or Jimmy John's sandwiches or Planet Fitness. The franchise model is all they do and know, and that's where they operate in terms of finding good investment opportunities. Those are the type of private equity firms we look to invest with. So even though there's this trend towards investing more and more capital in private equity, there's still a lot of opportunity to extract value from private equity and other illiquid asset classes. Doesn't mean that more capital won't flow into it. That seems to be a big trend. You just have to be a bit more precise about with whom you're going to invest and how they're going to generate those good returns in the private equity space. I'll stop there. Those are two trends that I think are pretty clear to everyone.
Well, one last question. I mean, you've had a successful career and you've been active with CFA Institute for over the years. I think you've directly and indirectly touched a lot of young professionals. So speaking to that group, what advice would you give young professionals working to build a place in this industry in terms of the mindsets and the skills to have and really to lay the foundation for a good career?
A wonderful question. I often get asked, by people who are, early in their career, Mark, should I go through the CFA program? And my response is, well, think where you might be 3 years from now. Would you like to be 3 years from now with your CFA or not? Then I believe the question is, oh, sure, 3 years from now, I'd love to have my CFA. I said, here's your answer. Go do it. It won't be easy. We all have a story to tell about how we suffered through those study programs and those classes, but we all made it through. The second thing is I tell them is, when I first heard about the CFA program, I was in graduate business school. At that point, I thought, I'm getting my graduate degree in business school. The CFA thing, no, I probably don't need that. And that was a mistake. It wasn't until I got out of business school, began working on Wall Street, got in the asset management industry, and then recognized and realized just how valuable the CFA certificate was. And so went back and did it. And wish I had done it when I was in grad school. It would have been so much easier. But I had to learn that lesson. And the other thing that I try and tell young men and women in this industry is, if you get the opportunity to work overseas, do that. The CFA platform is now a global platform. And not only is that, but the asset management industry is a global platform. I learned so much by living and working in London for a few years, just getting outside the U.S., getting a different perspective, getting a perspective that wasn't through the lens of sitting within the United States helped me so much in my career. And again, because I had the CFA degree behind me at that time and it had my charter, I had the confidence that I could take that step to work outside the U.S. So again, for young men and women, take the CFA. It's well worth it. Don't put it off. Do it as soon as you can. And then take that charter and do creative things with it. Go work outside the U.S. if you get that opportunity.
That is awesome. Well, on that note, we'll stop and I'll thank you so much for joining us.
Oh, it's a pleasure. Chris, thank you. That was so much fun.
Thanks.
I'm Mike Wahlberg, and this has been The Enterprising Investor.